Hello and welcome to the latest of our Insider Interviews video series. Today I have with me Simon Brazier, who is the fund manager of the 91 UK Alpha Fund. Simon, thanks for your time today.
It's great to be in here, Carl.
So Simon, the fund seeks to find great UK listed businesses. So how do you go about finding them?
Well, we're very clear what we're looking for with companies, and our ideal company is one that is typically globally diversified, cash generative, defensive, that isn't actually relying on the short-term sort of movements in economics and markets to perform. And ultimately, these are companies that we look for that have great business models. So it may be that they have barriers to entry which enable them to continue to grow over time. They grow their profits over time and turn those profits into cash. So we're looking for great financial models where these companies typically have strong balance sheets. And finally, capital allocation. And this is the bit where we think a lot of people ignore, which is good companies are often great companies because they allocate capital well. They take their cash flow and reinvest it either into good M&A, good capital investment back into their businesses to grow, or often, sometimes the best thing is to return their cash to us as shareholders. So that's what we're looking for. And finally, valuation is clearly very important. I'm sure we're going to come on to talk about that.
Does the fund follow a particular investment style, such as growth or value? And what's your thoughts on the market rotation that's been taking place since the beginning of this year?
We've tried to be diversified, so we do have the majority of our stocks in what we would call quality companies, the ones I've just described, which are long-term quality investments, good quality long-term businesses. Having said that, at the right valuation, we are prepared to buy more cyclical names, or we're prepared to buy more value names. And you're completely right, Carl. It's been incredible actually this year to date, how you've seen the real drivers of the market has been mining and oil actually, and it's almost those value stocks that have, as you said, have been driving the market. You know, we are slightly overweight oil, and we have been buying quite a lot of that through last year because of valuation. So we are prepared to go anywhere, but ultimately the core of our portfolio is those long-term defensive compounding positions that we own.
BP and Shell are among your top 10 holdings. Have they been long-standing positions, or have you been adding to them more recently? And with the fund, are ESG factors considered at all?
Yeah, so just taking the former question on BP and Shell, we were about 8% underweight the oil sector as we came into the pandemic. But we really felt there was an opportunity both back in 2020 and then since then, particularly as you've seen the oil price rise. I mean, we're pretty simple on the oil names, which is above $60 oil. Typically, these companies generate enough cash to replenish their assets and to pay their dividend. And at $100+ oil, they look very, very attractive from a valuation perspective. And with everything that's going on geopolitically, we really felt it was a good time to be owning these names. Having said that, a lot of people can throw stones at you from the ESG perspective. Now, overall in the fund, we are very, very focused on corporate governance, but also thinking about the environment, etc., and sustainability. I mean, we focus on two main things really. One is, I want to know what is material for the company. There's no point, for example, I was in Finland last week meeting Sigma Rock, which is a aggregates business. We're looking at their cement plant, which is actually on the Russian border. And for them, their biggest issue clearly is the emissions from the cement plants from their aggregates business, rather than really focusing on board diversity. Yes, it's important, but it's not the most material thing. Whereas, for example, a company I own called FDM, which is a training business, actually, they don't have very little impact on the environment, apart from maybe a bit of travel. The most important thing there is diversity through how they train people and their board. So it is horses for courses, but it's very important. Coming back to the oil sector, I have to be honest with you, BP could be one of the greatest sustainability companies I could own for the next 10 years in terms of its impact. If BP is able to make that transition towards net zero, and it can create an environment whereby, or it can affect the environment positively in terms of how it produces its energy, that actually has a bigger impact on the world than many other companies. So we work hard with companies to ensure they're moving in the right direction, rather than just saying we won't own you because you don't tick the box right now today.
Amongst the top 10 holdings are a number of companies that are in the FTSE 100. Is it the large cap names that you're finding most value in at the moment?
The fund has always been quite diversified, but I think relative to most of my peers, I have fished more in that FTSE 100 space. Personally, I think there's some brilliant businesses in the UK, ranging from Diageo, Reckitt, Unilever, London Stock Exchange, Experian, which are some of the best companies I think you can find globally. So Yes, right now, also with some of the pressure you've seen on input cost inflation, which has affected the valuations, I think, of the likes of Unilever and Reckitt Benckiser, or London Stock Exchange, where people have been worried about the Refinitiv deal, actually it is giving us some opportunities, I think, to buy some of these names. And if you look at them relative in valuation terms to some of their comparative peers elsewhere in the world, in Europe and the US, they look even more attractive.
There's one bank holding in the top 10, Lloyds Banking Group. Do you invest in any of the 4 other UK listed banks, and why is it that you're preferring Lloyds at the moment?
Well, just taking a step back, I mean, we have always been keen in the financial sector to actually play the strong structural trend of the savings market in the UK. So actually, I've always had bigger positions in companies like Hargreaves Lansdown, Schroders, Integrafin, Quilters, companies that get that exposure to that long-term trend, even if there is pricing pressure, even if there's market volatility. Having said that, within the financial sector, I have owned Lloyds for some time. For me, it is probably it's probably the most utility-like of the banks. You know, it went through the crisis, it didn't take the government's pound, it restructured its business quite quickly, and it will return most of the capital that it generates back to me in cash. So I think it's probably one of the sort of more defensive UK banks. I do own HSBC, slightly different for different reasons. One, it clearly gives me protection from rising interest rates, as they do better in a rising interest rate environment. But not only that, I do think that Noel Quinn, the current chief exec, is changing that business in quite a positive way. I sort of spent 20 years watching that company with a pretty stable return on equity that was quite low. I think Noel Quinn is now repositioning the bank from west to east, and also really getting under the skin of the returns the investment bank can make there. And so we've increased that weighting this year.
Simon, thank you for your time today.
Thank you.
That's all we have time today. Do check out the rest of our insider interviews on our YouTube channel, where you can like and subscribe.